Kiyosaki's crash calls. Should investors listen in 2026? The financial world is split on the future of the stock market. While major firms like Goldman Sachs predict continued gains, a 12% return for the S&P 500 in 2026, personal finance personality Robert Kiyosaki warns of an imminent crash. This begs the question, should investors heed Kiyosaki's warnings or dismiss them as unfounded? The bullish outlook. Why experts are optimistic. Recent data supports a positive outlook. The S&P 500 rose 1.4% in January, historically a strong indicator of annual performance, averaging a 15% return in years with positive Januaries. The Federal Reserve's expected easing of interest rates, coupled with a healthy economy, further fuels this optimism. The market has seen strong returns in recent years, 18% in 2025 and 25% in 2024, leading many to expect another profitable year. Kiyosaki's warnings. A history of predictions. Kiyosaki has repeatedly predicted major stock market crashes. In January 2025, he warned his followers on X of a crash in February, citing his book, Rich Dad's Prophecy. He doubled down in November 2025, advising to buy assets instead of selling. His core argument centers around a coming mass exodus from stocks and bonds into Bitcoin, potentially driving the cryptocurrency's value higher. However, Kiyosaki's track record raises questions about the reliability of his predictions. Experts weigh in. Why timing the market fails. Financial experts largely dismiss Kiyosaki's crash predictions. Robert Johnson, a finance professor at Creighton University, argues that predicting market crashes with precision is impossible. He emphasizes that attempting to time the market, whether buying high or selling low, is a losing strategy. There are few, if any, investors who can consistently predict market downturns accurately. The danger of panic selling. Acting on speculative predictions can be detrimental. Investors who panic sell based on social media warnings may regret their decisions later, damaging their long-term financial goals. Experts warn against making rash decisions driven by fear rather than sound investment strategies. A pattern of unfulfilled predictions. Vince Stanziani, a self-made trader and investor, points out that Kiyosaki has a long history of calling market crashes without a proven track record. This pattern suggests his warnings should be viewed with skepticism. In conclusion, while Kiyosaki's predictions grab headlines, they lack substantial evidence and often contradict broader market trends. Investors should rely on diversified, long-term strategies rather than speculative predictions from unproven sources. The financial landscape is complex, and attempting to time the market is a dangerous game with little chance of success.